Welcome back to another episode of the Real Life Investing Podcast with Jason and Rachel Wagner. We have an exciting one. Rachel, we're going to be talking taxes today. You know a lot about taxes?
I know like this much about taxes. Not a lot, no.
Okay.
Thank gosh you do them for us.
Okay. Yeah. Well, we have a superstar. Ryan Bakke is with us. Honestly, so Ryan runs around the Chicago investor circle. That's kind of how I met you. And dude, you're like the little Alex Hormozy of accounting. And I want to say that as like as a true compliment. I think you've got an incredible mind. You're the only guy that I actually know that can make taxes sexy. And so I'm excited to kind of have you on and just kind of share some things. Ryan, we get a lot of comments about, hey, I want to get into real estate, and I heard all about how, people don't pay any money in taxes, and how do I do that? And those questions come to me as the real estate agent, but I often am like, you got to talk to Ryan about this stuff because he knows the ins and outs and he knows all the specifics. But without further ado, Ryan, thank you for joining us. And why don't you just real quick give your brief background and then kind of talk about how people can get into real estate and start saving on their taxes kind of right away. So,
Awesome, thanks. Yeah, have an accounting and finance background. That's what I went to college for, and I had a really good finance professor throughout college who she used to work on Wall Street, basically running investment funds for real estate properties. And so I always had like real estate kind of in the back of my mind just because of all the nice stuff that she had said about it. And it wasn't until I worked in my first accounting internship while I was in college where I was preparing two tax returns one day, and there was a tax return for a married couple making $200,000 on a W-2. And then I did a tax return for a single guy living in Chicago who owned like 18 apartment buildings. And he made more money, about double the money that they made. And he was single, which meant he was in a higher tax bracket to boot.
hmm,
And he paid less in taxes than the married couple. And at the time, I was like, wait a minute, did I do something wrong? Am I going to get fired or lose my job? And my boss, Jim, at the time, he's like, no, it's because he invests in real estate that he pays less in taxes, even though he made more money. I'm like, damn, I got to figure out everything there is to know about this. And so at the time, I accepted the offer at Deloitte because it was the best opportunity for me. But I didn't stop reading the Bigger Pockets books. I didn't stop reading the real estate books and just trying to understand everything that I need to know about this. And bought my first rental property through a house hack, FHA. And while I was like studying for the CPA at the same time, like that's when I really uncovered the tax code for real estate investors. Whether you're doing multifamily, long-term rental, fix and flips, even we save people money on fix and flips, and then the short-term rental tax loophole thing kind of really blew up for us because it is a loophole in a sense where people can buy Airbnbs that are doctors, tech workers, high income earners, and can use it to offset their taxes. And um, I think one of the things that I discovered very early in my career that I think is worth its weight in gold is if you want people to understand something, you have to make it very simple. The average American has a fourth grade reading level, and that's even true for even some of the people that we're around, right? They're intellectually very smart, but they have to get an understanding of it. That's why there's a show called Are You Smarter Than a Fifth Grader? Or there used to be with Jeff Foxworthy.
yeah, yep.
In order to make somebody understand something, you have to make it simple. You have to use analogies, you have to use metaphors, stories. And a lot of that kind of segues into that marketing piece. Like I remember like my favorite thing to do for a long time was to send a daily email. And I would have this super complex topic about 1031 exchanges or how to know when to sell, all this stuff. And like I'm like, okay, people are opening it. I get a lot of opens, but I'm not getting a lot of clicks. I'm not getting a lot of feedback.
Hmm.
Well, it's because I was writing at an 11th grade reading level, my emails. And so back before ChatGPT, there was a thing called Hemingway, like Ernest Hemingway, the writer, where you could put your copy in there and then tell it, hey, rewrite this at a fourth grade reading level. And as soon as I did that, I saw click up in conversions and people becoming clients. And that was one of the biggest lessons for me is you have to make something, plausible, reasonable, simple for them to understand, especially if you want to motivate, influence, persuade people to do something.
Yeah. Yeah. So, like the standard, like let's just talk about this situation real quick. Let's just say you have a married couple like us, me and Rachel. Um, but let's just say we are both W-2 earners. And can we buy real estate and save money? Like, is that a thing that is for us and our family and how we can make that work? We both have great corporate jobs. We both make $100,000 a year, right? Can we buy real estate and help that purchase offset our income
Yeah.
and
I
save money
think
on
the
taxes?
I think the big big misconception out there is like, hey, if you're not a real estate professional, you don't do Airbnb, like you're not going to save any money when it comes to taxes. And it's not the truth because right away, any dollar that you make in real estate is taxed a lot less than the income at your W-2 job because you don't have to pay this thing called Social Security and Medicare tax. If you look at your W-2 pay stub every week, there's a line that says SOC or there's a line that says MEDI, and you're like, who are these people and why are they taking 7.5% of my money? Well,
Hmm.
when you earn money for a living, you're paying into that Social Security and Medicare system, right? Well, rental income by default, you don't have to pay that Social Security and Medicare. So it's like you automatically, if you had 50K of W-2 income versus 50K of real estate income, you're automatically paying less than taxes on the real estate income. Um, Not to mention the host of deductions and exclusions and expenses that you get to take to offset the real estate income, like your mortgage interest, property taxes, insurance, and then the eighth wonder of the world that I like to call depreciation. But that's why people generally pay less in taxes if they own real estate. And then as you're holding onto that asset, those capital gains are taxed at very favorable rates, 0, 15, or 20%, depending on your income that year. So had I have made that 200 grand at my corporate job in a gain or a stock bonus or whatever, I would have been taxed at 35, 37% compared
Hmm.
to when I sell that property and cash out, I'm only taxed at 15%. So
Hmm.
it's a very advantageous asset to hold over time. And we've definitely had a lot of clients who pretty much shift their income from W-2s to real estate because number one, you actually don't need to make as much since it's getting taxed at a lesser rate. Um, and think about this too, like for somebody to cash in on their W-2 career, right? Like all this equity that they've basically built in themselves. They need to get a higher paying job. They need to get promoted. They need to get a huge stock compensation or whatever. They need to have equity in the company. That's hard to do for most W-2 people.
Hmm.
If I got a property that's appreciated 100, 150 grand, $200,000, I can borrow against that equity, right away and like cash in on that versus if I want to cash in on my W-2 or my corporate career, it's going to come with a lot of taxes and it's also going to be a lot harder to do. Cash out refinance isn't a taxable event. So,
So that actually interests me because when I think about like a 1099 earner, for example, they don't on the front end have any like Social Security or Medicare taxes coming out, but it does come out when you file your taxes. So that's not true for like rental income, is what you're saying.
correct. Yeah. It'd
Is
be the same federal and state tax
yeah,
on the income, but rental income doesn't have the Social Security and Medicare. Like if you're a W-2 or, if you're a 1099, you actually pay double the Social Security and
more.
Medicare because you're technically
Yeah,
the employer and employee of the month in your business. When you
Nuts.
work a W-2, your employer matches your Social Security and
right.
Medicare. Um,
So is rental income the only income that's like that then, where you're not?
it's so passive income is basically by default all rental real estate. So single family, multifamily, short-term rentals, uh, self-storage, like it's rental
So
income.
yeah,
The only
interesting.
other, form of passive income, which is a lot harder to earn and achieve, is like say I invested $300,000 into your guys' real estate business. And like, here's money for marketing, here's money for ops, whatever. And I'm passive, like I don't make any decisions in that business. I just get a K1 at the end of the year. That's also considered passive income. So
Mm.
we've had a not a ton, but we've definitely had a couple dozen clients who are doctors, lawyers, professional service businesses that they own the business as an equity partner, but they don't run the day to day.
Oh,
Well, that's considered passive income to them.
yeah.
And so if they have any form of a passive loss, from a rental property, a K1 syndication, any sort of rental loss, those two actually offset each other. Yeah, it's pretty neat.
That is
Yeah.
pretty interesting, actually. Yeah, nobody really talks about it from that angle
Yeah.
of like investing in someone's business and
It,
having that be a passive, investing in someone's small business that you know.
over the last couple of years, there was a lot of controversy around like people's tax returns getting leaked. Bezos, Trump's, a couple other people. And I actually like when it did leak, I wanted to look into, one of those returns.
Hmm.
And basically all like the first page of their tax return, there's nothing because they don't earn a job, they don't pull money out of retirement, they don't draw Social Security. Everything's on the back half of their return where it's all passive income.
Hmm.
So there's no Social Security, there's no Medicare taxes. It's all this passive income. So like a guy like Bezos or Warren Buffett, they can have a lot of income coming from one business. If they have losses or expenses from another one, they just offset each other. And
Right.
at the end
Yeah.
of the day, their AGI is zero and they don't pay any federal income tax.
Yeah.
Yeah. That's why Trump, like one year I saw like Trump paid like $284 in federal income tax.
Right.
Yeah.
Yeah. Yeah. Yeah. And people have always wondered, like, how is that legal? Well, the code has been written to allow these activities to take place, right? So I guess like how could so kind of summarizing what we just previously talked about is like even if you have two people that are corporate W-2 people, they can still it's still in their best interest to actually get into real estate because you do get some type of tax benefit that comes through it because you get to offset, the expenses of the property, the mortgage interest, and then you have that depreciation part, right? So, but then let's talk about like from another perspective of well, what is this real estate professional status and how can somebody, maybe that's a couple, qualify for real estate professional status and what does that kind of look like?
Yeah. So yeah, the tax code incentivizes certain types of behaviors. They like literally write that thing to incentivize people to act a certain way. And so if you look at the members of Congress, it's all people who own property, businesses, or stocks, right? So that's why the tax code is most favorable for those types of people. Well, in a situation where you have two W-2 earners who are not in real estate, any loss that's generated on the property gets carried forward and used in the future. So, like, say the first year I buy a property, I got expenses, repairs, maintenance. I generate a $30,000 loss on paper. Um, I just carry forward that until I either have income or I have a gain. Like if I sold a property, losses from some properties will offset gains from another's. So we've had
Mhm.
clients utilize that strategy a lot. So it's like you sell a property for a big gain. Well, you better also have a loss coming from something else to be able to offset it. But one of the things about the tax code that I used to say all the time that still really interests me is the name of the game is how do you defer recognition of income as long as possible. So like if I have money, I don't want to pay tax on it now. I want to pay tax on it later because the purchasing power of the dollar is always greatest where it is right now because of inflation. So it's like if I have a $50,000 tax bill because I made a lot of money this year, I want to defer that 2, 3, 4, 5 years down the road and pay the 50 grand 5 years from now because the 50 grand isn't worth as much.
Yeah.
Um, on the other end, if I have expenses or if I have a loss, well, I want to be able to use that as quick as possible. It's like you probably heard the ads if you listen to the radio, the JG Wentworth commercials. It's my money and I need it now. Called JG Wentworth 877 cash now.
Yeah, yeah, yeah.
877 cash now. Well,
A good jingle.
if I generate a loss on a property, it's in my best interest to be able to use the loss as quick as possible. Now, for rental, real estate, long-term rentals, multifamily specifically, commercial properties too, the only way to do that is to be a real estate professional, or
Mhm.
have one spouse be a real estate professional. And the rules are like weird, for a certain reason. They wrote this part of the tax code in 1993, so it's been, um, I don't know, over 30 years now. And it's actually one of the most litigated parts of the tax code because of how powerful it is. Okay. So if you're going to do it, you got to make sure that you know the rules. The first rule is basically, um, the real estate professional status designation. It's one person, one spouse has to hit it. Okay. And in order to hit that, you have to spend 750 hours in what's called a real property trader business. So that could be you're a real estate agent, you're in project man, or you're in construction, you're a flipper, but basically you spend 750 hours. One of you has to spend 750 hours. You can't combine your hours for this test. It's one person has to meet the 750 hours in real estate. The part that, so if you annualize that over 50 weeks, it comes out to be about, um, what is that, like 15 hours a week, I think.
Hmm.
So somebody who's a full-time agent is easily going to hit that. The
What
part
about
that,
lender? Are they considered a real estate professional?
so only if, yeah, if they're a 1099 lender, yes.
Okay.
If so, the little carve out, if you're a W-2 in real estate, let's say I'm a W-2 for a property management company. There's a court case where if you don't own at least 5% of the company that you get a W-2 from, those hours don't count. So if you're a
Hmm.
lender, in order to qualify for reps, you got to be a 1099 lender. You can't be a W-2 lender unless you
Oh, that's
own more than
fascinating because actually
5%.
a lot of lenders are actually W-2
Mhm.
lenders.
So if they
Um,
if they got audited, all the IRS has to do is say, show us that you own 5% of the company.
Hmm.
Yeah.
I see.
So the part that trips most people up with that is not only do you have to spend 750 hours, but you also have to spend more than half of your working hours in a year. So, say the average American works, I mean, we probably work more than this, you know. But let's say the average American works 2,000 hours a year. Well, I would have to spend 751 hours, more than half of my time in real estate compared to my W-2 job, right? So if I'm a CPA and I work, 40 hours a week, well, I would have to spend 41 hours a week in real estate.
Yeah.
Impossible to do if
Yeah.
you have a full-time job. But we've had clients, say somebody quits their W-2 in like April or May, and has a lot of properties or is going to start buying more properties. Like we've had clients qualify, utilizing that. Most of the times it's one spouse that's a real estate professional, and then the other spouse has a high, corporate, high income job.
Mhm.
Um, where that real estate professional, they're 1099. Most of the time they're an agent, um, real estate
Can they
agent.
be property manager?
Yeah.
Yeah.
Yeah, property, like if you're a 1099, if you're a property management company, you own your own business,
Yeah.
that person will qualify. There's 11 different qualifications, but like property management is one of them.
Yeah. So a spouse, so I'm a doctor. I make $1 million a year doing surgeries, and my spouse manages the properties, and we go out and buy a couple properties a year. That would kind of qualify for offsetting the earned income.
Yeah, as long as that others, because remember that you can't count the hours towards it. So if I'm the doctor and I have a spouse that is supposed to be that real estate pro, I better let them do all the work because they
Yeah.
they on their own have to hit the 750-hour test in order to
Yeah.
be a real estate professional. Um,
And
How,
not have another full-time job because more than half, right?
right.
yeah,
Yeah. So I'd be like unemployed essentially, or maybe a part-time job if I could start
part-time
a full-time
agent.
job. And
So we've seen the clients do that too, so then they don't have to pay commissions when they buy and sell. They get it in their own pocket,
okay.
right?
Have you ever done an analysis of like when that would make sense to encourage that type of scenario where, we're just it's very common nowadays where it's just like, yeah, both spouses work because that's just what we do. But is there a scenario where it's like, hey, one spouse is actually making a significant amount more money, and maybe you should, because of, X amount of dollars, you'll actually potentially make more money by saving in taxes than you would by doing your corporate job and not taking advantage of the tax benefit.
Threshold.
Yeah, is
Yeah.
there like a threshold or
Yeah.
break
Like
even
if both
point?
spouses are making, real good salary, real good W-2, at what point does it actually make sense for one to break off?
Yeah.
Yeah. So as a general rule, I always tell people that you're gonna come out ahead by making more money and paying the tax than if you didn't make the money at all,
Okay.
right?
Yeah.
But in a context where you have one spouse that's like, $500,000 plus earner, and then the other spouse is making, under six figures, let's say.
Hmm.
Um, well, it's actually so you boom, you're in a 37% tax bracket. So it's like plus state. So like all the losses that you have, you're basically saving, 42, 43% on the dollar in tax savings. Um, they have to be, and then what else are you getting for like having the other spouse stay home? Well, you might be able to lower your like daycare costs, right? You might be able to lower some other stuff, assuming that the 500K earner has like health insurance and benefits, that stuff type of stuff covered, right? In order for it to make sense, they would have to basically have a high earning year or um, continue to have 5+ year run where income's super high, and they have to continue to buy properties every year.
Hmm.
Um, because it like let's say I buy a $1 million house, and I generate sometimes it could be $100,000 loss or $100,000 tax savings on $1 million house. Well, that covered that person's 65, $70,000 salary. But I would
Okay.
have to I would have to do that every year to make the argument like, hey, the $65,000 spouse can stay at home or become a real estate professional instead of not working. But it's probably more like a peace of mind thing, where if you try to get the math to work out, basically it has to be every year you're earning a lot of money and every year you're buying properties. But I think there's more kind of like not math that's involved of like peace of mind of, having more, free time taking care of stuff around the house. Because like even my wife and I work full time in our own like respective things. She's a nurse. I'm a, you know, business owner. We still don't have time to get all the stuff done around the house sometimes.
Yeah.
Like, you know, um, but yeah, I mean, clients have definitely done that before, you know.
You've mentioned a few times showing a loss like on your tax return. Can you kind of dumb that down and speak to what types of losses you would qualify, you would show? Like if you're buying a property, why are you wanting to show a loss? What is that? What does it look like? That kind of thing.
Yeah, so losses are great if they're the right type of losses. So I wouldn't want to show a loss. This is the thing like business owners get wrong all the time. Hey, I'm going to write off literally everything under the sun on my business or not report as much so that I don't have to pay the taxes. Well, good luck going to get a loan. I had a buddy of mine I went to college with. His dad was a mechanic. He became a mechanic. He's like, Ryan, I made $70,000 cash on the side. I'm not going to report any of it because they don't know that I made it, so I'm not going to pay taxes on that. I'm like, well, good luck trying to buy a house, you know.
Yeah.
Um, so like losses in business, bad. Uh, in real estate though, when we're talking about these losses, they're not actually cash losses. They're losses that are generated through the write-offs that you get in real estate. So like the tenant paying down your mortgage, like you're writing off the interest on that. Property taxes are a write-off, a deduction. Insurance is a deduction. Obviously, those two are like cash coming out of your pocket, right?
Hmm.
Ideally, the tenant's paying that down. But then this thing called depreciation, right? Where depreciation is this phantom loss, I call it. You're not actually shelling money out for depreciation. It just shows up on your tax return. It's based on the purchase price, amortized over either 27 and a half years if it's a long-term rental or 39 years if it's a short-term rental. So like say I buy $1 million, LTR, like I'm getting a $30,000 loss, $30,000 expense every single year that I own that property. Um, and in the beginning, I'm going to have a lot of losses because, well, I got a mortgage interest that's front loaded, right? I got to learn how to like
Hmm.
stabilize this property. So, but the thing about that loss is, boom, I have to pay taxes on it. If I'm a real estate professional, that $30,000 loss, that's not real, it's fake. I can offset my 37% tax bracket with. So I just saved $10,000 in taxes by doing that. And then, the best part about the real estate losses is lenders, if they're following like, Fannie, conventional underwriting is they're supposed to add back certain expenses on your tax return
Hmm.
back to your income to help you qualify for a refinance or the next property. So
Right.
like in that example, say I had a $30,000 loss on my tax return, but $30,000 of that was depreciation. Well, now I'm
Yep.
back at zero. What was my insurance? 2,400. Now I'm at 2,400 of income. What was my property tax bill? 12K. Now I'm at 14 grand. What was my mortgage interest? 20,000. Well, now even though I showed a $30,000 loss, my income on that property for lending purposes is 34,000 because they're supposed to be adding back all of those expenses.
So I have a question about the depreciation just a little bit further. So being in the Chicago market where all these properties are appreciating in most of the neighborhoods, at least that's what my Wagner report guy keeps telling me. So are you still showing depreciation on your tax returns if you have an appreciating asset? If your
Correct.
property, wow.
Hmm. Yeah, that's the yeah, it's weird. It's like, most people are like, "Oh, but I thought real estate like appreciates, right?"
Right.
It does. But from a tax perspective, that's basically the way of the government pretty much incentivizing you to invest into real estate. And if you think about it, it's like, okay, when you buy the house in 2026, like you buy a house in 2020, I bought it for 240 or 250. Well, the stuff that's inside of the property, which is what gets depreciated, the roof gets depreciated, the furniture, the flooring, the drywall, everything like depreciates. It's because that stuff loses value over time. So the roof that I bought in 2020 is not worth the same in 2025 or 2026. Like,
Yeah.
so that's sort of the government's way of like giving you that incentive is to say this stuff depreciates in value because it's true. Like if you bought a house in 2020 and it came with furniture, you're not selling that furniture today for the same amount that you sold it for in 2020 unless it's like an antique or like,
Yeah.
Queen
And then I
Elizabeth sat
assume
on
each
it or
time you
something.
replace it, you would depreciate that new roof, for example, and get
Yeah.
to show that loss again.
Yeah, that's,
Okay.
it's probably more in the weeds, but
Yes, fine.
um there's a tax term called partial asset disposition. A partial asset disposition. Try saying that 5 times fast, right? And like most accountants miss this because most accountants aren't real estate investors. So the way it basically works is, okay, I buy a house in 2020, and that house has a roof on it when I bought it. So right off the bat, I'm taking that roof and I'm depreciating it over 27 and a half years, right? So let's say the roof is worth 20,000. I depreciate over 27 and a half years. So I'm getting like, I don't know, $800 deduction every year for in a row. Well, in year five, let's say I have to replace the roof. Okay. Well, I have to incur the expense of a new roof. So I get to put that on the new depreciation schedule. But what a lot of people miss is if I don't do anything, now I'm depreciating two roofs. Well, what the partial asset disposition is, I get to remove the cost of the old roof off of my tax return. And I get the expense for what that would have been over the next 25 years, and I get it in the year that I replace the roof. So when
Oh,
you when you buy a new roof, you get to write off the remaining cost of the old roof as an expense, and then I also get to put the new roof on the tax return because otherwise I'd be depreciating two roofs.
Yeah.
Um, it's
yeah.
kind of like think of it like
So you don't have to wait, but you don't have to wait. It's kind of in your benefit though, right? Because the original you were waiting that 27 and a half years. You
yeah,
replace it now, you don't have to wait for that time period to capture the depreciation value, right?
yeah. It's kind of like when you trade in a car, you buy a new car. What do you have to do? Remove the old car off your insurance. policy. So you don't pay insurance on two cars when you only have one. Well, that's kind of like what you have to do on the tax return is if I'm doing like a huge remodel, I have to write off the cost of the old assets so I can get that value, right? Because if I don't do this, it's incorrect,
Hmm.
but I'm not getting it's my money and I need it now. Like I had to replace the cost of the roof. I want to write off the old cost of the old roof, right away in the first year.
Now, Ryan, can you do this stuff with your personal residence, or does it need to be investment?
So personal residences, what you have to know about a personal residence is keep receipts and keep kind of like an Excel file of all your modifications and improvements that you do. Personal residents specifically have probably like the best part of the tax code where if you live in it for at least 2 years, you can exclude up to $250,000 of gains if you're single and up to half a million if you're married, right? So you buy a house for 500K, 5 years ago, now it's worth a million, and you're married and you live there, you can sell it for $1 million and pay nothing in taxes. Um, the only like three things in the tax code that are completely tax-free events, tax-free, which is different than tax deferred. Tax-free is I get the money and I don't have to pay taxes on it. Something like a 1031 is like I'm not paying taxes now, but I'm just deferring it down the road. Like I'm
Mhm.
kicking the can down the road. So that's the difference between like a tax-free or a tax deferred. Even a refinance, it's a tax deferred event. It's not a tax free event. It's just deferring the taxes. The only three things in the tax code that are completely tax free events. Number one, when you sell a primary home and you live there for at least 2 years. Number two, any sort of like life insurance that you pull out is tax free. And then the third one is inheritances. Those are typically tax free. That's like the only three things in the tax code that are completely, 100% tax free.
Hmm.
Um, so we don't really see a lot of people pay taxes on their primary residence unless they like live there for a very short amount of time and the market just went bonkers, or they live in like California or wherever that golf course is in Georgia.
Well, that's
But
really interesting. That makes me
Yeah.
think like we've like always throw around ideas about, okay, if we were to leave this house and buy another house, should we just keep this house and rent it? And it makes me wonder if it makes more sense because of current appreciation, if we should just sell it because we wouldn't be taxed on that
Yeah,
gain
there's an analysis
versus,
there.
well,
Yeah.
yeah, there's a real analysis there. It's really
Yeah.
yeah,
interesting.
it's so we help clients go through that all the time because part of that rule is basically it's a 2 out of 5 year rule. So say you lived in a property for 2 years or 20 years for that matter, and then you're like, hey, I want to move out of this thing. Okay. Well, you actually have up to 3 years from when you move out to sell it tax and get that tax free. So what a lot of people can do is like, hey, I'm going to move out of this. Let me keep the mortgage intact because it's low.
Hmm.
I want to generate rental income with this. Use some of that rental income to help, qualify for the next property. They can rent it out for up to 3 years from when they move out, and then as long as they sell it before the 3 years is up, it's still a tax-free event.
Hmm,
Let's talk.
But
Let's talk
that's
about this from
interesting.
the.
but
Yeah,
the
no, it's
but
great.
the thing is if you like say 3 years and one day goes by
Yeah.
and you go to sell it, all taxable.
Yeah.
I
The
was gonna
only
say
thing
you
that you
missed the
could do at
window.
that
Yeah.
point would be to 1031. And again, the
Exchange.
1031's tax deferred, it's not tax free. So most of the time, anytime you can take tax free money, it's always better than like deferring it, I think. Um,
Yeah.
you
Let's
know,
talk about this from the because I recently found this out. I went through an analysis on this. If you buy a 3 unit building and you live in one of the units and you do the whole house hacking thing, this rule doesn't quite. It's not as straightforward. What I've recognized, and maybe kind of talk through that a little bit, just because you're only occupying like 1/3 of the building.
yeah, so it's only the part that's actually used as your primary that qualifies.
Hmm.
So if you house hack something, and let's say right off the bat you lived in the bottom, rented out the top wouldn't qualify for the 121 exclusion because it's only the part that's your primary residence. Um,
Mhm.
you actually can have a hybrid. So you had a 4 unit where you lived in one and rented out the other three. In the same transaction, you actually can 121 exclude the part that you lived in pay no capital gains on that. Then you can 1031 the other three units. So it's
Well,
like the part that you the part that you lived in, that's a tax-free event. You pull that money out right away. The
yeah,
three units that you rented out that were rental assets, you can 1031 those into something else.
yeah.
Um,
And so,
right.
and just real quick, 1031 means,
The easiest way to explain it is like playing Monopoly when you trade the four green houses for a big red hotel. Like you're trading up an asset, and the government incentivizes that because um, they want to keep think about it like they don't want that property to have too much turnover. Like they don't want to displace tenants. They don't want to like make a mess of everything. So they want you to be able to sell that house and then go buy another house. As long as you use the equity that you got from when you sold the house, you can buy another house and have it be a tax deferred event. It's probably done too much. Like most investors think like, okay, I'm gonna go sell this house. Like the only absolute thing for me to do is a 1031. Um, but there's like other strategies out there. There's other things that could impact that decision. So, like for example, we were talking about the losses that carry forward, right?
Mhm.
Well, I had a client one time, new client, who's like, "Hey, I'm selling this house. It's got $200,000 gain, and I'm gonna 1031." And I'm like, "Okay, let me look at your last couple of years of tax returns." Well, she had $300,000 of losses carrying forward on her tax return. Those losses get released when you have a gain. And so instead of this client having to go through the 1031 process, which can be hard, 27% of all 1031s fail, actually, where she had to basically double the size of her asset. She was used to, managing a 4 unit property. Well, in order to do the 1031, she would have had to trade up and get a bigger property because what you sell it for is what you had to purchase for. So
Mhm.
she had originally bought, a $700,000 house. She has this huge gain. Well, now she's got to learn how to manage $1 million house or, $1.1 million house. And the timing, you have to, when you sell that first property, you have to identify up to three properties within 45 days of sale. So especially if we're in a buyer's market, if we're in a like a competitive market,
Mhm.
uh, it's hard to execute that because you basically have to go under contract within 45 days,
Yeah,
of selling the first property.
yeah,
So there's these. I don't think it's the end all be all. It's definitely a good strategy to go to. Um, the timing of the year, I think, impacts 1031s. Like I always tell people, like the worst place to be in is to be a 1031 buyer in a period of declining interest rates, because the competition is going to get, every 1% the interest rate goes up or down, it swings the amount of people that actually can afford a house,
for
right?
sure. Yeah.
Um, and so the worst place to be is that 1031 buyer in a period of declining rates. Why is it also bad to be a 1031 buyer? Well, if the seller knows that you're buying with 1031 funds or the seller's agent knows, um, good luck getting concessions. Good luck like waiving, or like being able to
Yeah.
waive contingencies.
Yep.
Like,
If you know that, that's such useful information because I've been on the side where we represented 1031. And actually, so here's what we call it. We call it hot money.
mm, there you go.
Because that money is going to close that deal. Okay, so I've represented sellers and we knew on the other end that we had a 1031 coming in. You didn't have to give up anything. We knew that they were going to buy that property. I've represented the buyer. The same thing. Hey, Jason, we're 1031 in this. I'm not going to share that info. But when I have the conversation with the buyer and I said, here's the things that popped up in the inspection, and he's like, okay, we're going to try and negotiate, but if they don't give it to us, it doesn't matter because I'm buying the property. Right? So if you have that tidbit of information, it's hot money coming in.
Yeah, and I didn't know this when I first, because I was again, I don't think I'm like a Lewis and Clark or a pioneer by any means, but I was like one of the first CPAs, at least that I know, that talked about this concept. If I'm buying with 1031 funds, the last thing that I want is the selling party to know that I'm buying with 1031.
Hmm.
Because I'm again
Yep.
concessions,
Yeah.
contingencies, et cetera, right? And some states it's a required disclosure. So like in California,
Oh.
you have
It's
to
on our
disclose.
contract. It's
Yeah,
on our contract that you can select the box. But
yeah.
I would never select the box. Don't select the box. You don't have to disclose it. It's actually it's
Yeah.
not part of law here that you have to disclose that information.
Yeah. So that's a consideration,
Yeah.
too, because if you're that 1031 buyer in a period of declining rates or a super competitive market, like the odds of you doing that 1031 are not as high. Um, so the closer the closer that it gets to the end of the year, at least for me, I'm less likely to do a 10 or less likely to recommend a 1031 exchange for a client. Why? Well, if it's if it's October 1st, they sell a property. We're not going to know until November 15th if they're able to identify the three properties.
Hmm.
Even if they identify the three properties and like let's say they put one of them under contract, we're still not going to know for another 30 days if they actually close on it or not.
Hmm.
Now the end of the year is already passed. Well, guess what? If you don't complete the 1031, guess when the tax bill is due? April 15th,
Hmm.
right? And you have no, like, you failed at 1031, you have no outs, you have no exit strategy. There's nothing you can do at that point to like minimize the capital gain. You basically are paying that tax bill and, pocketing the money and then doing something else. Versus like from a, from my perspective, the best time to go into a 1031 is at the beginning of the year as quick as possible because say I enter into a 1031 in March. I'm going to know by April 15th if I could put in a property under contract. That I'm going to know, you know, in the summer whether or not I actually close on that property or not. Say I don't close on the property, I still have 6 months to do what I call a lazy 1031 exchange, which accomplishes the same thing as a 1031 exchange. It's just you're buying a new property and you're using the depreciation from the new property to offset the gain on the old property.
Hmm.
Um, so basically, it accomplishes the same thing as a 1031, except you don't have the 45-day identification window, and you don't have the 180-day deadline to close. As long as you sell a property and buy a property in the same calendar year, like the losses from the new property will offset, gains from the old. You just got to make sure you buy a big enough asset.
Yeah. Yeah.
But if
So
you
timing.
1031 towards the end of the year, you have no outs if it doesn't go
Yeah.
through. Yeah.
Yeah. Timing is so important. Awesome, man. Awesome. Well, this was a fantastic conversation. Rachel, real quick, just because how we wrap these up, what was kind of some of your biggest takeaways from this conversation with Ryan?
Biggest takeaways is the passive income is taxed less than the rest of your income. I didn't entirely understand that. Oh, this little piece of the personal residence having 3 years to make that decision seems like it's a great test if you're not sure what you want to do, if you want to hold a property, if you want to rent a property. Like you could try renting it for a couple years. If it doesn't work out, sell it, and you could still not be taxed on that gain. That's very interesting. I actually want to talk about
Well,
that.
yeah, yeah, because it's a real scenario. Yeah, I mean, well, and also you can move back in to, right, for Ryan, you can move back into that property too. So say you moved out for 3 years and you've already passed your window, you could go move back in for 2 years to
Yeah, and
then,
repeat
right,
it.
Restart the clock.
to then restart the clock. Yeah, so you can.
Assuming you actually live there and you're not just, yeah,
Well, yeah, yeah, and that's yeah, you have to live there. You have to live
you
there.
have to live there.
There are so many times where I have real estate investors that are like, "Yeah, we're just gonna live there." I'm like, "No, dude, you have to live there. Like
Yeah.
that's a thing." So,
Yeah,
uh,
or a scenario too, like say you knew, okay, I want to use this money to trade up and buy another house, like whether it's another primary or whether it's a rental. Um, at that 2 year mark, when you move out of it, like you could refinance. Like once you get a tenant in there, you got rent coming in, you could pull the money out, get some of that
mhm,
money out now, wait your 3 years, let the tenants pay down that 3 years of interest or like 3 years of interest costs to you. But,
mhm,
you know, now you kind of get a best of both worlds because it's like you're still renting it out. You're still getting that 3 years of appreciation on it if you think
mhm.
it's going to go up. Because if
Yep,
you just sell it right there at that 2 years, you're losing out on the appreciation over those 3 years. But like
yeah,
your goal is like, I want to sell it. I actually like that strategy probably more than just a simple like sell and then buy
mhm,
because if you just sell and buy, there's a lot of risks that are associated there. It's like man, you have this money, it's sitting in cash, it's in a bank account. Yes, it's tax free, but every time that it sits in the bank account instead of in a property, it's losing value to inflation. So
Hmm.
it's like you could refinance after the 2 years, go buy something else, continue to rent out the property, and then you'll get the other amount of equity that you might have in it when you sell it, right?
Yeah. Yeah, yeah, no, it's brilliant. And then real quick, I think that one of the biggest pieces here, and then we'll wrap up, is let's talk about what a cost segregation is and how people can use that to their advantage. Ones that are qualified for real estate professional status, and then ones that maybe aren't.
Yeah. So we mentioned before that when you buy a rental asset, the government gives you depreciation, but by default it's very slow and it's over time. So on $1 million house, I'm getting 30K of depreciation every year for 30 years, essentially. Well, it's my money and I need it now. So I want to be able to speed up the rate at which I'm getting those tax benefits, right? When I was young, my parents bought me this Winnie the Pooh ceramic piggy bank. It was about yay high. And
Hmm.
every year I had a birthday, my dad would put $50 in there. He's like, "Oh, you can have it when you turn 18." And I still haven't gotten it yet. Uh, but the only way that I could break the bank and get the money out is I had to smash the Winnie the Pooh jar. There was no way for me to like take money out of it. Um, well, that's what a cost segregation study is like you're front loading the tax benefit that you were supposed to get over 30 years, and you're actually getting 25 to 30% of the total benefit in the first year. So that on $1 million property, like no joke, the $30,000 write-off can turn into 250,000 in the first year. Maybe sometimes as much as 300,000. So it's like now I'm getting 10 times the tax benefits that I would have gotten in the first year, and I'm front loading that. And if I could write that off against my income, if I'm in a 30% tax bracket, 300,000 in depreciation saves me 90,000 bucks. Compared to before, I was only saving 30 grand times a 30% tax rate. I was only saving $9,000.
Hmm.
So if you're in those high tax rates and you're a real estate professional, like you should be leveraging cost segregation to be able to accelerate those losses um, that you have. Um, use cases use cases outside of being a real estate professional. Um, if you have a ton of like, say you had 4 or 5 properties that are all cash flowing, like loans are paid down, you're cash flowing a lot, and you never heard about cost segregation before. You can go and do a cost segregation study on an old house that you have, pull some of those tax benefits out to offset the rental income that you have. Um, you could also buy the sixth property, do a cost segregation study on that, use the depreciation from that one to offset the income from the other 4 or 5 that you have.
Yeah,
Um,
right.
or or we've also, you know, one of the things we talked about is that passive income bucket. So, say I had a house that I sold for a huge gain and I didn't want to go through a 1031 exchange. Well, I can buy another house, do a cost segregation study on that one, use the depreciation, the losses from that to offset the property that I had a gain on. So, there's like a lot of use cases, different
Yeah,
scenarios.
yeah, yeah. No, that's brilliant, man. So it seems like because you'd mentioned that every year you kind of need to pull this off. Where if you have a high earner, right, you have a high earner and you are buying property every year, it is one of those pieces where you need to do the cost seg in order to kind of really have like the biggest benefit, right?
Yeah.
Yeah.
And it just goes back into, as an investor, like, because I study finance in school, and one of the biggest topics was always time value of money and what's called payback period. So payback period is how quickly are you basically making back your investment, you know?
Mhm.
So they would give us analysis of like, hey, you're going to buy $100,000 machine, piece of machine, and it's going to run at a $20 an hour profit margin. How many
Yeah.
hours do you have to work the machine in order to pay it back, something like that. Well, like as an investor, if I'm going to come up with, say, I'm going to come up with $100,000 and put it into a property, but that property is only cash flowing $5,000 a year, it would take me 20 years to pay back to basically make back what I invested. Well,
Yeah.
if I got a $30,000 tax benefit on top of that in that first year, that's going to accelerate my payback period a lot quicker. So it's all
Yes.
about like if you're fronting money for anything, you want to be able to recoup that as quick as possible in the form of tax savings.
Yeah. Yeah. So you could be like, you really could be analyzing deals on an after-tax basis.
Yeah, like we always teach people, focus on cash flow, focus on appreciation, focus on loan pay down, but don't ignore the tax benefits, what you get out of that because that's going to be like most of your return the first couple of years because you're
Yeah.
not paying down as much principal. The equity is going to build up over time with appreciation and loan pay down. But for a lot of people, what's the best part about it too is whether you put 5%, 10%, or 100% down, you get the same tax benefit either way.
Hmm.
You get the same tax savings. So, a couple years ago when you could like at least on the Airbnb space, like people could buy a $500,000 cabin for 10% down, 50 grand down, they would save
Second home. Yeah.
$70,000 in taxes and basically their down payment got funded by the government.
Right. Yeah.
Yeah, it was nuts. But whether you put 3, 5, 10, or 100 down, you still get the same tax benefits. It's one of the reasons why real estate's the best. I can't $50,000 in Apple stock is only going to get me 50K in Apple stock.
Yeah.
Uh, and I don't get any tax write-offs with that. $50,000 is going to get me a $300,000 house, and I'm going to get appreciation on 300K. I'm going to get tax write-offs on 300K.
Yeah.
You know,
And this is kind of the hard part. So when we're in a high interest rate environment and when you don't have the cash flow that you've always been wanting to have and like, hey, there's no deals out there, there's no cash flow. Well, this is where you really need to start recognizing that there's way more to real estate. And actually your return can still be quite large, even with something that has very little cash flow when you start factoring in appreciation, pay down, and that mighty tax benefit piece. And then I think that's most people have a hard time like putting a number to that. Like, so does your team offer anything in terms of, hey, if I bought this one property, like what is the what's the potential write-off that I could get? Do you guys offer that type of service to some of your clients?
we don't do it as a one-off, but we do help people understand, how much money they'll actually save by buying a property if they're a
Yeah.
client of ours.
Yeah.
The two biggest factors in that equation are number one, what's your tax rate? You know, well, in order for us to know what your tax rate is, we got to get a projection of what your income is going to be for the year, you know? So it's like, how much money do you think you're going to make? Well, somebody in a 37% tax bracket is going to save a lot more money in taxes than somebody that's in a 24% bracket,
Hmm.
right? So if I have the same $100,000 write-off because I bought a $500,000 house, am I in a 24% bracket? I'm only saving 24 grand. Am I in a
Yeah.
37% bracket? I'm saving 37 grand on the same house, right? The other big component in that equation is um, the breakdown between the building and the land value of a house. Where you buy is very important for tax purposes. Because if you buy a property where a lot of the value is attributable to the land, so think like, beach markets, Destin 30A, um, even like some stuff that's, closer to the water in Chicago, like the land is going to be worth a lot of money where the property sits, and you don't get tax write-offs for land. Um, Weird example, but like I had a client who bought $1 million property in Smoky Mountains, Tennessee, $1 million cabin there. She saved $130,000 in taxes in the first year, because the land in the Smokies is worth nothing.
Hmm.
But then she bought $1 million house in Gulf Shores and she only saved $30,000 in taxes. And I'm like, well, yeah, you should have let me know that you're going to do that because the land in Gulf Shores is worth 70% of the purchase price. Um,
Yeah.
so we try to do a good job. We try to train our clients to look at that. If again, taxes aren't like the only thing or the biggest thing, but if you have that tax focused mind, like where you buy is really important.
Yeah.
Because you don't want to buy something that's all land. You won't save a lot of money in taxes. The other reason, the best part about that is you actually can look up on the county assessor website and see the breakout between land
Hmm.
and building, right? Or go look at 5 or 6 recent sales that match similar square footage, bedroom, bathroom count in the same area, and you'll get a good idea of what that tax benefit's going to be. The other reason why you do that is you want to know how high your property taxes are going to get reassessed.
That's right. Yeah, that's a huge component. This
Yeah.
was awesome. Thank you for coming on. How can I mean how can people refer people to Ryan Bakke? Because like there's always, hey, we need the tax guy. And I have a number of friends that are like, I self-prepare, things like that. And how can people refer you business? Because I feel like they need to get connected to the right person to do their taxes, and especially as they step up, they level up a little bit and they get into the real estate game. There's so many levers to pull. There's so many different types of conversations. So what's the best way to get in touch with you, and how can people refer you business?
It's on all social media platforms. Is just at Ryan Bakke CPA. And as far as the referral piece goes, I have a school community. It's skool.com
Hmm.
slash taxes. You can join in there for $1. You also get an affiliate link that you can share with people. So if they join their group or they, buy products or services from us, you'll get automatic affiliate payout that way.
Oh, amazing.
Yeah.
It's awesome. School
Yeah.
games.
Pretty
Alex
cool.
Mosey. That's why I told you you were the little Alex
Yeah.
Mosey.
Yeah. I was the early adopter to school. Um, I got the record for the longest webinar on the school platform, 12 and a half hours straight. And
What? Holy cow.
yeah, we have the probably the largest active tax community on school too.
That's amazing, dude. All right, I got to check that out. That's awesome.
Yeah,
Well, dude, thank
awesome.
you. Thanks for the time. Thanks for all the knowledge, and really appreciate you coming on. And everyone, if you found any value in the show, I'm certain you did. There's actually tons of value. There's literally monetary value that we learned today on how we can buy real estate and help it offset some of your income, and how we can pay less in tax. So if you found any value in the show, please share it, and we will check you out on the next episode.